Hi, welcome to Market Minute. Big week this week. We do have Nvidia's user conference. That's going to be interesting to hear some of the comments out of that. The Fed meets on Wednesday and releases their dot plots. So remember the dot plots. This is really important for the markets. And if the 10-year Treasury continues to rise, it's going to be a big problem for the stock market. So the Fed meeting is really important to dissect what they're trying to convey to the overall markets. However, we think they're going to have a little bit more hawkish tone than what they did in December when they released the dot plots. So the Nvidia user conference, they're going to talk about their vision and some of their partners. And I think the big issue for the market is the sustainability of spending on Nvidia gear. So we don't know if it's an open-ended thing that's going to last for a long time, or if this year or next year is the bubble year for all this spending to occur. We think that the big value added won't necessarily be just getting the information to move quickly, but it's getting to the information dissected properly by using software to do it. So we think that the venture firms are going to exploit the software opportunity and bringing a number of companies public over time. The other issue that's kind of interesting is the power needs. Our analysis says that there's about a 7% increase in power or electricity that will be necessary over the coming years. So we're looking at ways to play that. That's kind of a no-brainer, in our opinion, to play that. So we looked at a company called Vertiv, and I guess every dog has its day. I'm not saying that the VRT is a dog because it's having a great day or a great 12 months. It's outperformed Nvidia by double over that period of time. What these guys do is they supply the liquid cooling for data centers. Energy is a big requirement. To cool it down is a big requirement. So if you can save costs by cooling these systems down by using liquids to do so, much cheaper over the long term. So a big move in the stock. I can't say we're too excited about it, but it's something that we'll watch. We prefer looking at, and this one would be a good one to play, but we prefer looking at the old line tech, as old line tech is going to benefit from AI once AI is more fully implemented. The Federal Reserve meeting on Wednesday, the old dot plots, okay? Remember what the dot plots are. They are the committee, the people that, the Federal Reserve members that are attending the meeting, they give their expectations of real GDP, unemployment, inflation, and the federal funds rate, looking out for this year, next year, the following year, and kind of what longer term looks like as well. So in the December meeting, so they do this every quarter, the December meeting, the Federal Reserve expected 3 rate cuts or roughly 75 basis points to occur in 2024. The market instantly jumped to saying, okay, well, let's expect 6, and the market had a nice rally into this year. Now we think that the market just has momentum, and because of the momentum, it's not really paying much attention to what the Federal Reserve is saying. The S&P at 21 times earnings is discounting a 3.2% yield on the 10-year Treasury, and I'll walk you through that here in a second. But that's not currently what's in the markets. So we think something's out of line. Either the bond market's wrong or the stock market's wrong. It seems like the bond market's been much more conservative about things from the beginning. So the long-term view of 2% inflation and 2.5% on the Fed funds, we're not even close to that really on both measures, maybe more so on inflation. But let's walk through this a little bit. So GDP this year of 1.4%. GDP is currently running at roughly, as you can see out here, roughly 2.3%. So, the Federal Reserve is going to probably readjust their expectations, or they're going to look for really an ugly trend in the back half of the year. Unemployment rate 4.1. Well, we're currently at 3.9. So this is nicely off the bottom and looks like it's trending higher. We think it's probably going much higher than 4%, maybe 4.5 to 5 over time. So that's probably going to have to change a little bit as well, their expectations. Inflation, the PCE, roughly at 2.4. We're about at 2.4. So you can see that on the chart. It's come down nicely. The CPI, however, is hanging up there. It's not coming down very quickly versus the PCE. And then the PPI was hot again this past month. So we don't think inflation is solved. And I think Powell's comments about wanting to see more inflation data before they do anything is very appropriate. And probably wanting to see the unemployment rate higher as well. If the unemployment rate is higher, then they can afford to cut rates and maybe be a little bit wrong, be a little bit too lenient. So I think the unemployment rate has to go higher as well for the Federal Reserve to cut rates. So we think what's currently in the market is, as you can see on this chart here, is 2 to 2.5 rate cuts this year. So you can see this is the 2-year Treasury note and compared to the federal funds rate. And they move highly together. So as they're raising rates, the Federal Reserve, the 2-year Treasury is a little bit forward thinking, and it's going up a little bit faster until they finally meet. And then what's happened here is the federal funds rate is roughly 5.33% currently, and the 2-year Treasury is 4.68. So it's roughly 65 basis points difference between the two. So the bond market is saying 2.5 rate cuts this year. We're leaning towards 2 to 0 rate cuts this year. So again, critically important, the message that Powell gives on Wednesday as to and how the stock market reacts to that. So we think it's set up for a negative expectations in terms of what he says. Now, the Federal Reserve summary of all this. So let's kind of walk through this a little bit. What does it mean for the stock market? So we have the 10-year Treasury at 4.3, and the yield on the S&P 500 earnings yield. So it's the earnings divided by the price of the S&P 500. So it's roughly $243 in earnings on the S&P, and then the S&P 500 is around 5150. So if you do that math, you're at roughly 4.75%. It's way too low for where the 10-year Treasury is. So the 10-year Treasury is going to have to drop in yield, or the stock market's going to have to come down. So if you look at the PE of the stock market, roughly 21 times earnings, it implies that the 10-year needs to go to 3.2%. I don't think that's going to happen. So we're looking for probably a correction in the stock market. Maybe the stock market needs to be hit over the head several more times before it actually corrects. So it's important as to what the Federal Reserve says on Wednesday. The stock market is roughly 19% overvalued relative to where the 10-year Treasury is. The 10-year Treasury should be around 3.2%. Something's got to give there. Remember, we think that there's risk in the overall stock market, at the short end of the markets in terms of the Treasury market looks compelling. The stock market is being driven like crazy by AI, and I think the Nvidia users conference will shine some light onto things that are going on in that space. And then the other thing that's really working well, the banks have popped back. I don't know if you noticed that, but the banks are starting to work. We think they're probably nicely ahead of themselves, however. And then healthcare, which is probably our favorite sector of the market, and in particular the small cap biotechnology names. If you can withstand the risk, there's tremendous upside. And then lastly, We think the yield-oriented part of the market looks really compelling. If you need some retirement income, given the T-bill is at 5.4, we can go out on the yield curve a little bit and get as much as 8 or even potentially 9% on yields. So we're being cautious on the markets. I think a correction will occur here in short order, and we're planning on taking advantage of that. So our philosophy of loss-averse investing means to buy low and sell high. We're currently high, so we're being defensive. Thank you very much. Hit like, subscribe. Come to my website, Patrick Adams CFA, and sign up for a hard copy of Market Minute, which we send out every Tuesday. Take care.